I think it's always good that we have Matt and Amanda about this time of year, so you can still pull off some miracles that they know how to do. I did that one year, and I was pretty excited. I was in the back, and I heard I could do something, and I thought, I did not know that. Probably saved me about $30,000, so that was fun. With over 38 years of experience in taxation and accounting, Keystone's professional CPAs provide top-notch financial and tax solutions in assisting clients achieve maximum profitability on their businesses and investments across the U.S. Founders Matt MacFarland and Amanda Hahn specialize in bringing top-notch tax-saving strategies that are traditionally only available to Fortune 500 companies to their firm's clients. Matt is managing director at Keystone and is a frequent tax contributor to NBC News Radio's Smart Money Show. You can find Amanda in publications like Time, Realtor Magazine, and as an ongoing contributor to biggerpockets.com. We welcome you back.
Well, thank you, Bruce and Aaron and the rest of the Norris Group for having us.
Yes,
You guys enjoying yourselves?
Yes, thank you guys for taking out your this beautiful Saturday to spend your time here with us. And Matt and I probably do about 3 to 4 speaking events a year, and this is by far our very favorite because of the panel of speakers that's here. And like Bruce said, I mean, even for us, we always learn something new as well when we come to hear the other speakers. So thank you guys so much for coming. I know we have clients that's come from far away, and we've met a lot of new people who's come far away. So we hope to give you some really great information.
Now, one of the things we do like to do when we start our presentations, and throughout our presentations actually, is that we like to do pop quizzes. So you guys probably didn't think you're going to have a quiz on a Saturday, right? But that's what we're here for. So.
I just want to let you know the prize for the quiz is our first and new book that we wrote that came out earlier this year. We're really excited about it. So for anyone who knows the answer, please raise your hand, and we'll be giving out the free books to the first contestant.
All right, so the first question is, the average American spends more money in taxes than they do on, is it A, food, B, clothing, C, shelter, or D, all the above combined?
This gentleman, the blue. D.
D, good guess.
Very good.
And this is where it pays to sit in the front, obviously. So.
Yeah, because I'm wearing heels today, so I
Yeah.
wasn't going to walk all the way back there.
So this might become, I don't know, when Amanda came up with this slide a couple years ago, this actually came as a shock to me, even though I do taxes every day for a living. But when you think about it, you know, ABC News actually came out with a survey a couple years ago where they had studies and showed results of that the average American is spending more money on taxes than they do on some of the biggest other items combined. Now let's look at it. Let's look at some of the stats behind it, and you can kind of see why. Right now, the highest federal income tax rate is at 39.6%. And just a quick stop, the before and after. Before is what the rates were like 2 years ago before the recent tax change. So right now, the highest federal rate is 39.6. For all of us who are lucky to live here in the state of California, our highest rate is just over 13%. If you work for yourself, you have payroll taxes, you're paying at 15%. Obviously, all of us real estate investors in the room, when you sell a rental property, what are we paying? Capital gains tax, right? So that's part of income taxes, but the rate did go from 15 to 20% on the higher end. Estate taxes, if you die without a good estate plan in place, you could be looking at estate taxes of 40%. And this doesn't cover some of the other things that we all pay every day, right? Sales tax. All you real estate investors, what are you paying on your properties? Property taxes. As you see at the bottom here, this kind of got something listed for Medicare tax. This doesn't even include 2 new taxes that came out about 2 years ago as a result of the whole healthcare overhaul. Those are adding another 3.8 and 0.9% taxes to some people. So some people might be adding an extra almost 5% to their income taxes every year. So you can see quickly if, again, these are the highest rates. So, not every, you're not paying every dollar, you're not paying it 40%, obviously. But as a general guide, you can see where someone might be paying 50% or 60%, depending on how much money they're making.
And I just have a question. Does anybody know, we put on here before and after, and Matt just said it was before and after the most recent tax act that was passed. Does anybody here know what the name of that tax act was? Just shout it out. No? It was actually called the Americans Taxpayer Relief Act. surprisingly enough. That was actually the name of it. So it's very good marketing, right? They put a spin on it. So I don't know how many of you feel relieved if you look at the before and after, but that was the name of the act.
I mean, that's actually that's a very simple name to say compared to some of the other stuff they come up with. So, all right, so we're going to touch on a lot of things today, a lot of things specifically around year-end tax planning for real estate investors and some other pertinent topics. One of those is LLC issues. Now, not to pick on any attorneys in the room, I'm not going to ask you to raise your hand and admit that you are one, but we go to events like these, or not like this, but we hear a lot from our clients of feedback that there's a lot of attorneys out there that are pushing to form out-of-state entities in Nevada, Delaware, you name it, Wyoming. But California is becoming very aggressive in wanting people to register and pay the $800 minimum tax for LLCs, even out-of-state entities. There used to be a tax where the minimum tax is $800, and if you didn't file, didn't pay, they would come after you eventually, but the penalty was like $200. But starting in 2014, they've changed it now that if they find out about you and they come after you, they can actually impose not only the $800 tax, but it's a penalty of $2,000 per entity per year that you have not filed a tax return if they deem you to be doing business in California. So then the next natural question is, well, what is California's definition of doing business for an LLC?
And there's two requirements, and if you meet either one of those, then your entity is going to file in California. One is that the owner of the LLC is a California resident, okay? And two, which is if the entity is doing real estate business or any kind of business in the state of California. So again, if you meet one of those two definitions, then your entity, regardless of where it was formed, is going to file in the state of California and pay the California minimum fee per year, okay?
So let's just go based on those rules. Let's go over a couple examples just to make sure we're driving home the point.
These are just common questions we get.
Yeah, these are common questions. So California resident is the owner of a Nevada entity that owns a rental property in California. Do we need to file in California, pay the $800? Yes, because there's actually two reasons here. One, the property is located in California, and two, the owner is a California resident. So change it up just slightly. California resident is the owner of a Nevada entity that owns a rental property in Nevada. So again, a very common question. It's so common that the Cal Franchise Tax Board put this example in their instructions. You have a property in Nevada, you have a property in Arizona, you've got a property manager on site that does everything. You collect a check once a month, you deposit in your LLC bank account. In the Franchise Tax Board eyes, unfortunately, that's enough to be deemed to be doing business in the state of California. So next one, California resident is the owner of a Nevada entity that owns nothing and has no income yet. Yeah, and that's true too. I don't know if there's a fourth example on here. Did we take that out about the?
No, we took that one off.
Okay. The only twist on this might be, we had another example up here sometimes. We talk about the LLC owns a second home in Nevada. Owner is a California resident, but it's a second home. They're not renting it out. It's just a vacation home. You go from your primary residence to there when you want to go visit the shows in Vegas or whatever you call them. But that example is one of those exceptions where even though the owner is a California resident, they have an LLC, that probably doesn't have to register and pay taxes. And the reason why is because the LLC is not deemed to be doing business. It's just being used for asset protection to own a second primary residence. There's a few exceptions to this, but these are the general rules that you need to be aware of. So again, why is this important? Well, California is becoming, like I said, very aggressive. They're starting to send out notices when they are finding out about these entities. How are they finding out? The IRS is sharing a lot of information nowadays. There's probably a lot of other jurisdictions are doing the same thing, to be honest with you. But when they find out, they're sending you a letter in the mail. And if you get that nice little nastygram in the mail, don't throw it away. Don't put it in the drawer. Forward it to your CPA. But basically, it says you have 60 days to remedy the situation. 60 days meaning 60 days to file any back tax returns that they're asking for and pay the $800 for each year. Otherwise, they're going to impose that $2,000 penalty per entity per year that I was talking about. So again, that's why that 60-day period, they give you a little leeway, but again, it's, don't sit on it, obviously, if you get it. It's something to look at. All right, I think it's time for another pop quiz. All right, which of the following celebrities went to prison for failing to file tax returns? All right, Tim McGraw, Chris Tucker, C, Wesley Snipes, D, Bruce Norris. What?
Okay, gentleman in the back. Middle. Yes. Long hands. Wesley Snipes.
Wesley Snipes. All right, see you tomorrow, Amanda. Yeah, so this is a true story. It sounds like a lot of you are aware of Wesley Snipes. I think he read one too many of those articles from those tax avoidance people that said you don't have to pay taxes at all. It's all a scam. And he bought into it, I guess. So they caught up to him. They sent him to prison. I think I don't know, do we have a picture? Is that?
No, I took it out.
Okay, but I think he turned 50 while he was in prison, and he looked pretty darn good for 50 years old. He was in pretty good in shape.
So he celebrated on taxpayer dollars, right?
All right, when we do speaking events or talk to new clients, meet investors like you guys, a lot of times we hear a recurring theme is that people just don't know what is tax deductible. Now, for a lot of investors, we don't forget the normal ones, right? Like mortgage interest, property taxes, insurance. Those are ones that we tend to remember, obviously. But it's a lot of the other things that get missed. Nowadays, a lot of business owners are using, obviously, cell phones, laptops, vehicles, other gadgets in their business. I'm not a tech person, but you guys could probably shout out 30 different gadgets that are out there for your business that's helping you. But a lot of times, people forget that if you are using these in your business, that you can take tax deductions for these items now. And so that's the one that gets missed a lot. Another one on top of that is like travel, vehicles. I've mentioned vehicles. We're going to talk a little bit more about vehicles in a while, but travel's a big one that gets missed a lot. If you guys, I know a lot of you are local, but your mileage here counts as a business deduction. If you flew from out of state, your flight here, your hotel costs count depending on what else you're doing for the weekend. But a tip on that is great because this is very applicable because we're having a Saturday function. If you what do they call this? It's called the sandwich test, right? Sandwich the weekend, right? So you say you travel on a Friday or Thursday, maybe you have a business meeting on a Friday, maybe you come to a seminar on a Saturday, and you fly home on Monday. Now, obviously, Sunday, Thursday, Friday, and Saturday would all be considered business days. But Sunday, you could go out, go to Disneyland, you could go do whatever you want. The hotel and the meal costs for Sunday are still tax deductible to you because you have a business day on the back end on Monday, so you've sandwiched the weekend in between. So now your hotel costs and your meal costs for the weekend can become tax deductible. Now, your cost of going to Disneyland or going to do something else, entertainment, may not be deductible per se, but at least you're getting your hotel costs and your meal costs for that extra day or two or three, whatever it is.
Yeah, and these expenses are deductible whether or not you have an LLC, okay, just to be clear. The LLC itself is not the importance. The importance is the expense you're incurring has to be ordinary and necessary as it relates to your real estate business. So if your real estate business is rental real estate or fix and flip or wholesale, the question is, you being here, right? We don't have an LLC yet maybe, but is it reasonable to assume that the reason I'm here today is because I'm learning for my real estate activities, okay? And that's a common misconception. People go out and form entities, but before the end of the year, because they feel like once it's formed, I have all these deductions. And that's incorrect. Once you form it, what you do have is $800 to the state of California. Yes, it is a tax deduction, but maybe, do we need it? Maybe, maybe not, okay?
And with year end coming up, now obviously is the time if you're sitting down trying to figure out what your tax liability is going to be for the year, now is the time to start figuring out what these, generally missed deductions are, because they can add up quickly. I mean, it's not uncommon for us to see this add up to $2,000, $3,000, $4,000, $5,000. So depending on your tax rate, that could save you lots of money, obviously. So don't forget about these things because, like I said, they do add up quickly. Go ahead.
So the previous one, does it have to be certain distance from the home to do that?
So the question, I'll repeat the question for the recording. The question was to deduct your mileage or travel costs, does it have to be a certain distance to be deductible? And the answer is no, there's no distance required. So an example would be your tenant mails you a check to your house. You drive 2 miles down to the bank to deposit that. That is a tax deductible business mileage, okay? So the key is not how far or how close, the key is how is that trip related to your real estate business, whatever that is.
But if I live in Riverside and I want to come to this event, I also would like to stay in HOA, not just for regular. Can I do that?
Are you coming to the brunch tomorrow? Yes. So there's your answer. So the question for this gentleman was, I don't live too far away, but I'm here, and I'm here for a 2-day event. Is it reasonable for me to incur such an expense to stay here rather than to drive all the way home? And the answer is yes. Okay. Another side of that example is if you didn't have any business purpose to be here tomorrow at the Mission Inn, that's going to be a gray area, right? So that's kind of just going to be depending on, do you have any other business reasons to actually be here? Okay.
And I think we'll hold the questions to the end just so they want to get them on camera and microphone, so as opposed to us having to repeat every question. So if you guys don't mind with that. The next tip we want to talk about is a home office deduction. So if you guys have an area at home that's dedicated as an office space and you are working from home, don't be afraid to take the home office deduction. This is one of those great tips that can turn what generally is otherwise non-deductible items on your primary residence, expenses you're paying that you don't get to deduct, and turn a portion of them into tax deductions.
How many of you guys have heard the home office deduction is a red flag for IRS audits? Oh, wow, still a lot. That's surprising.
Yeah, the home office deduction came out in the late 90s, if I remember correctly. And back then, it obviously was a red flag because it was brand new. But there was actually an article I read like a year or two ago that said about 50% of Americans have a home-based business of some kind. So, probably a lot of you I would guess, work from home, just usually the people that we meet at some of the different speaking events. So, again, don't be afraid to do it because, as I mentioned earlier, mortgage interest and property taxes, we all know that we can deduct on our primary residence. But it's the other stuff that you're paying, the insurance, the utilities. Maybe you've got HOA fees every month. Maybe you've got repairs you're doing to your property. Again, these things can add up quickly. Now the IRS has actually, in the Congress, recently changed it where they'll give you actually a standard amount for your home office deduction to kind of make it easier for you to take the home office deduction. But they give you the benefit of you can use that, or if you add up all your numbers and the percentages, apply the percentages, and that number ends up being more than the standard, you can take the greater of the two. So in either scenario, it can work out for you. So it's one of those situations that, like I said, it can add up very quickly.
Yeah, and to go over a couple of the more common myths with respect to home office deduction, the home office does not have to be a separately enclosed room. So it doesn't have to be a bedroom. It doesn't have to be something that has a door on it. It does have to be, like Matt said earlier, a dedicated space within the house that's used exclusively as a home office. So we have an example here. This is an extreme example. We want to come up with something more extreme here. It's the end of a hallway. Okay, so for that particular space, that could be a legitimate home office because the end of that hallway is not being used for anything else, right? That's not going to be a place where we're going to be eating from or playing on or anything like that. So it doesn't have to have an enclosed door in order for it to be a valid home office. Another common one would be it doesn't have to be your only office. So if you're someone with a W-2, you work from another office, but you manage your own real estate on the side, you could have a home office. That is the main office for your real estate activities. Okay?
Or maybe you're doing fix and flip, and you're paying for a storage unit to store your supplies, your tools, between jobs or whatever. Just because you're paying rent for a storage unit doesn't preclude you from taking a home office deduction. You're still running your business from your home office every day. So that is one that's often misunderstood. Now with the home office, a lot of times it is claimed on the personal tax return, but a year-end tip here is that for those of you with S corporations, you actually can get a better bang for your buck taking the deduction through the company. And the way to do that is to implement what's called an accountable reimbursement plan. It's just a kind of a corporate resolution document put in your minutes binder. But essentially what it allows you to do is that the company can write a check to reimburse you for the calculated amount of the home office deduction. Company writes a check, gives it to you by December 31st. Company takes a tax deduction for it, and it's tax-free reimbursement to you. So essentially, we shifted the deduction from your personal return to the company return. And on the personal, there's usually some limitations. On the company, there isn't going to be any limitations. So that's what we do for all of our clients with S corporations. It can work out really well. So.
Yeah, a question we get a lot is how significant is it? Because I know some people are still worried about audit risk and that kind of stuff. And the way you kind of, from a big picture perspective, the larger the size of your home office, the better the potential deduction. And the other thing to look at is the more expensive your household expenses are, utilities, mortgage, taxes, then the better, the higher the potential tax savings, okay?
So you think, again, going back to this example, you look at a small space, right? Like, well, how can that add up? But maybe that's a small apartment in New York City, and they're paying $6,000 a month in rent or something, so the numbers can add up quickly regardless of the space too.
And what we really like about the home office, what Matt was saying earlier, is that we get to take a deduction. We're basically shifting expenses that we were already incurring anyways in our personal lives, and we're shifting it from non-deductible expenses into legitimate business deductions, right? Which is different than I'm going out and spending money. I'm paying a CPA, I'm paying an attorney, I'm paying the state to get a deduction, right? It's not as ideal as just deducting what I'm already spending money on.
All right, another pop quiz. All right, the IRS allowed which of the following people to take a tax deduction for their breast implants after a court hearing? So you hear it all, guys. You hear it all here. All right, is it A, Dolly Parton, B, Lindsay Lohan, C, Chesty Love, or D, Kim Kardashian?
This gentleman in the green, C is,
C, Chesty
yes.
Love is correct.
I have to say that every time we give this quiz, the winner is always a male. Not sure why.
It's true. There's studies that back that up. But yeah, so when Amanda came up with this slide a couple years ago, I was like, come on, this can't be true. Like, what, Chesty Love? But yeah, really, go on Google Images and type in Chesty Love, and you'll see what we were talking about. But
Wait, the gentleman, you said you know this because you read the court case? Oh, okay, good. That's a good answer.
little nighttime reading. So yeah, so we'll call Chesty Love. We'll call her an entertainer. IRS challenged her, and she took it to court, and she actually won, and she was able to prove that her breast implants were ordinary and necessary for her line of business. But what's the great thing about it, right? They said, yeah, you can deduct it, but you can't deduct it right away. Why is that? That's right. Depreciation, they're fixed assets, and they have a useful life of more than a year.
Just like your real estate.
I don't make this stuff up, I'm telling you. So the point of this, obviously to be funny, but at the same time, it's not, it's not everyone's, I'm not telling that gentleman to go run out and get breast implants for his business, but, think about the things for your business that might be ordinary and necessary for your line of business. They may not be ordinary and necessary for our line of business or somebody else's, but don't be afraid to take tax deductions just because it's, kind of a little out of the box, I guess. Another great thing to think about at year end is how can we shift income? And when we say shift income, there's a lot of things we refer to here. We can be referring to shifting income from parents to kids, from a high tax bracket to a low tax bracket. Hire them in your business, get them to work for you, and take a tax deduction for it. And a lot of times the kids may not even have to pick up the income depending on how much money they're making. So if you're saving at 30 to 40% and they're paying at 0 or 10%, there's that rate differential that as a family you guys are going to get to save. And again, going back to the previous thing, we all know this is money you're spending on kids anyway, right? So how are we going to take a tax deduction for it?
Yeah, because one question we get might be, I'm helping out my daughter with her car, right? I'm helping her with her car payments. How can I deduct my daughter's car payments? Well, the natural answer is no. You can't take a deduction for your daughter's car payments. But what if you had helped your daughter, you hired your daughter to help you out in your business, right? And you paid your daughter to help you in that real estate. What you pay her is a tax deduction to you, and she can take that money and then use that to pay for her car payments, okay? So that's what Matt was saying about money that you're already spending anyway. How do we shift it so that it could be a tax deduction? And depends on the kid's age. I think for a lot of investors, you probably agree it's really a good idea to have kids or the next generation involved in your real estate business, because those are the kinds of things that are not really taught in schools, right, about how to grow and invest your net worth. So in addition to tax savings, there might be some personal benefit to working with family members. And when we talk about income shifting, it's not necessarily limited to your kids. We have a lot of people who shift income to their grandkids, right? Granddaughters, grandsons. We have people that are shifting income to their parents. Maybe the taxpayer is in a very high tax bracket, but parents are retired or semi-retired that have the time now and the ability to help out. So that might be something to think about as well.
And again, we say kids, you might be thinking 10-year-olds, but we were at an event a couple years ago, and a lady raised her hand, like, oh, my 30-year-old son just lost his job, and he's living with me. Are you telling me I can, hire him in my business and pay him and take a tax deduction for it? Yeah. So how many of you have the 30-year-old that's moved back into the house?
Millennial.
How many of you are the 30-year-old that moved back in the house?
Whoa.
Got a few brave souls. There we go. So yeah, age isn't necessarily a driving factor there. So again, it's kind of finding ways to save money within the family. Now on income shifting too, for real estate investors, markets have been up recently. There's a lot of people, at least what we're seeing, is considering selling properties. So with year end right around the corner, if you are going to sell some rental properties that are going to have some gain that you might be paying taxes on, if that property transaction is going to close, near the end of the year, if there's any way that you could kind of defer the closing of that transaction to January 1st, January 3rd, 5th, you're still going to get the money. It's just going to be a week or two later. But now all what you've done is you've shifted that tax burden from the 2016 year all the way to the 2017 year just by pushing the transaction back a week. So again, don't do it if it's going to kill the transaction, but it's ways to defer paying taxes. Now on the flip side, maybe you're going to be in the 40% tax bracket next year, and this year you're only in the 15% bracket. So if there's things that you can do to shift income from next year to this year, now you're paying taxes earlier, I get that, but if this year, if you pull more money into this year and you're still only going to pay 15% on it, and next year you would have paid 40%, you're paying it earlier, but you're going to save that 20-25% difference on that money. So that's something to think about. Bill's going to come up later and talk about 1031 exchanges. That's another example of income shifting, right? You're looking at selling a property. You're going to have gains. You might be paying taxes. Well, how do we shift those taxes to 5, 10, 15 years down the road? And you can do that by a 1031 exchange is one of those examples. So.
Oh, just a real quick, earlier, Karen was talking about retirement investing and self-directed and all that. And if you think about it, that's also a form of income shifting, right? Because we have taxable income. Instead of paying taxes, we're shifting it into a retirement account and then having that grow tax deferred, okay?
All right, bonus depreciation. I alluded to vehicles earlier. I'm going to give you vehicles as an example here with bonus depreciation. But bonus depreciation came out years ago, just taking a 30,000-foot level here. Depreciation, you get to write off the cost of equipment, furniture and fixtures, rental properties over a certain period of time. But for some of those smaller things, what we call personal property, stuff you can touch, like the equipment, the vehicles, furniture, the IRS came out with this thing called bonus depreciation. It allows you to take a certain percentage up front right away and then depreciate the rest over time. Now, a few years ago, that bonus depreciation number was at 100%. It's gone down, but it's still at 50%. So there's ways that, and it's not uncommon for us to meet with a client at year end and they're talking about, we're just asking questions and somehow comes up that they're looking at buying a new car that they're going to use in the business. Well, if you are looking at buying a new car, you can utilize bonus depreciation to write off at least 50% right away. If the car weighs more than 6,000 pounds, like a large SUV, you can utilize other things like Section 179 to really supercharge the deduction on your vehicle. So, if you're using a vehicle 80, 90, 100% for business and you pay 80 grand for it, there might be a way, it's brand new, there might be a way for you to write off $50,000, $60,000 this year as a deduction for that vehicle. So this can be very powerful, and it is going to be in place next year. But again, with year end coming up, if you are looking for ways to kind of mitigate your tax liability and you are in the market for a new car, this might be a way to utilize that benefit.
As it stands right now, the bonus depreciation is good through December 31st, 2017. Okay, after that, 50% goes away. It's going to be a lower percentage starting in 2018. And just something, just so we're clear on, we are not saying go out and buy a car for the deduction, right? But if you are in the market for a car and you're trying to decide, should I buy it, should I lease it? Obviously, on the purchase this year, you have a very large tax incentive to do that, right? Because if you're leasing a brand new car, there is no bonus depreciation. You don't own the car. The dealership owns the car, right? They're taking the depreciation. So in terms of, do I buy now, before year end? Do I buy January 1st? That might be something to talk with your tax advisor on, because one of the things that we'd want to know as an advisor is what is going to be your expected income next year, right? If you're retiring next year, maybe we buy the car this year, right? If next year you're selling a bunch of properties, you're anticipating a huge gain, then it might make sense to wait until January 1st to look at buying a car or any of the larger assets. And then depreciation is not just for cars, it is for furniture, fixture, appliances. So those are some of the just more common things that real estate investors typically look at investing in terms of, for their rehab or their rental properties.
Now, on our rental properties, a lot of us investors in the room know that depreciation was one of the best Christmas gifts the IRS ever gave us years ago, right? I mean, it's a way when you buy a rental property, you get to write off the purchase price of that property over time. Now, generally what we see is it's done, they break out the purchase price between land and building. That's what it's done 99% of the time. But that's not the only way to do it, and sometimes it's not actually the best way to do it. A better way to look at doing it is with what's called cost segregation or component depreciation. What we're talking about there is ways to break out the purchase price into smaller, those things that have useful lives of 5 years, 7 years, 15 years, instead of writing it off over 27.5 for residential or 39 for commercial. So what we're trying to do is we're trying to take some of that purchase price and write it off over a shorter period of time. Life of the asset, we're getting the same amount of depreciation. It's just how do we front load it so you get more deductions now, save taxes now, take that savings, reinvest it, go buy more cash flow properties. That's what we're trying to accomplish, obviously. Now, most of the time, cost segregation studies are done by specific companies that do these on a day-to-day basis. A lot of times they're engineering firms, just companies that specialize in these. But we work with those kind of companies and our clients to figure out what the estimated benefit's going to be and how much it's going to save you, and you can kind of factor in the cost-benefit analysis. Now, one of the misconceptions with this is, I think, from what we hear, is that people think, oh, I bought my property 5 years ago. I can't do cost seg because I didn't buy the property this year, and that's not true. We had a client come to us a few years back that had owned a property for probably a decade, and it was a big commercial property, and it was kicking off a lot of cash flow, and he was still able to do a cost segregation study, and it wiped out a huge chunk of his income. I don't remember the exact numbers of what it saved him, but it was tens of thousands of dollars. So don't think that just because you bought the property years ago, you can't utilize cost segregation.
I think another misconception I hear a lot about cost segregation is people feel that it only relates to large properties like commercial real estate, apartment buildings, things like that, and that's actually not true. Cost segregation is to accelerate depreciation, correct? And depreciation is based on the purchase price of your real estate. And so what that means is, if you're a real estate investor, you have you have 2 rental properties in Southern California that total $1 million. You would likely get the same tax benefit as someone who has a Texas apartment building that's 20 doors that they paid $1 million for, right? So it's based on the purchase price and not so much the size of the real estate. Okay, and like Matt said, it does result in very significant tax savings. I know we have a physician client out in Indiana, and he did cost segregation for the first time on all his commercial properties when we finished the 2014 tax returns, and his refund was a little over $200,000 in taxes. Yeah. So, and I mean, to be fair, cost segregation is not for everybody, but for the right profile of investor, someone with high income, someone with lots of real estate, or a large dollar amount of real estate, it could be a very significant tax savings.
And this is not, cost segregation doesn't have to be done by December 31st. If you wanted to apply for this year, you need to do it before you file this year's taxes. But again, if you're sitting down and trying to figure out what your tax liability, what your numbers look like this year, keep this in the back of your mind, is that, okay, this is something I can utilize if that tax liability number is too high for what you want to pay, which usually it is for 100% of the people, obviously. But
yeah, and I mean, it does open a lot of doors. I was talking to a client, or I guess we were talking to a client just last week, someone who's maybe looking at cost segregation, and this is it's kind of a different example where if he did cost segregation, he would have 0 taxable income. In fact, he would have a small loss. And so then we will look at, well, how do we best use that? How do we use that loss? So some other things that we're looking at is, can we convert some money from a traditional retirement account to a tax-free retirement account, like a Roth IRA or something like that, right? So even though it doesn't have to be done before the end of the year, if this is something you're considering, do talk with your CPA or your tax advisor before year end, so at least you can kind of get the conversation rolling and figure out, is this even something I want to do? And if so, what might be the tax impact?
all right, this is just a quick list of some of the quirky things we were talking about earlier about ordinary and necessary. This is just a quick list of some of the unusual court cases where people have gone to court against the IRS and actually have won. So one of
these
the
are
questions
things
we
that
like
they
to ask
said.
is, yeah, go ahead.
I would say these are things that, so the taxpayer deducted, and the IRS challenged them, took it to tax court, and where the taxpayer won, saying that these are tax deductible items. I mean, the key here is just to say, not all these are going to be deductible to all of us in the room, right? I mean, I might not be able to deduct a wig or pet food or something like that. Each case is specific to the underlying case. Oh yes, Matt would love to explain number 8. That is his favorite one to talk about, in fact.
Yeah, this is a funny story. So this is actually a real estate investor of all things. He had hired his girlfriend to be his property manager, so he was paying her to manage his properties, portfolio properties. IRS said, come on, you're just giving her cash like it's your girlfriend. But he actually, he went to court and he was able to prove that she was working, and he documented and everything, and he won the case. Yeah. Funny thing, one time we were doing this, showed this thing at the very end of our presentation actually, and we were short on time, we're running off the stage, and somebody might have been you for that matter, you yelled from the back of the room, tell me about the girlfriend example, and so because I was running off the stage, I just shouted out, oh, he was paying her for services. I was like, probably not the right description, but.
And you know what I love about your question and this whole slide is it's interesting, right? Because I think when we take a look at it for the first time, we think, wow, that's interesting. I didn't know that. I didn't know I can deduct breast implants or airplanes or girlfriend, right? But what is the story that Matt just told about deducting the girlfriend? We just talked about it, right? We just talked about income shifting. So he didn't shift income to his kids, he just shifted income to his girlfriend. And as long as he was able to prove that she was helping out in his business, which he did, then it's a legitimate tax deduction. And so the key is not to say we're all going to go out and deduct our boyfriends or girlfriends, or, I mean, if you're married and you're not supposed to have a boyfriend or girlfriend, then we don't want to hear about that kind of stuff. But
don't mention that when you're talking to your advisor.
But the key is just to make sure that when you're meeting with your tax advisor, or before you talk to them, if you have a large expense of some kind that you're not sure if it's business related, a really great tip is to, when you talk to them, is to ask them, not can I take a tax deduction for my girlfriend, but how can I take a tax deduction for my girlfriend, right? Because I think that will put you and your advisor in a more proactive or more creative mindset, right? And it's possible the answer is no, right? It's possible your girlfriend is not going to help you in real estate at all. Or it's possible that she's already doing that, right? Maybe you just haven't officially given her the pay in that manner, okay?
All right. For you, all that you own rental properties, one of the best ways for you to benefit from being able to deduct real estate deductions on an unlimited basis is with the real estate professional status. Now, we've seen on average our clients who can qualify as a real estate professional are saving $10,000 to $20,000 a year on their taxes because they can qualify. So with rental properties, we know that we can take our rental property deductions and our depreciation, offset it against our income. So we've got this and one more tip. Aaron's back there giving me the 5-minute jazz hands fingers, but we know that we can deduct our rental property loss deductions and our depreciation against our income. But if you make more than $150,000 and you have more losses and deductions on your rental properties and income, the only way that you can deduct that excess loss against your income, like W-2 or any other income, is with the real estate professional status. So common misconception with real estate professional is, oh, do I need to have a real estate license? You don't need to have a license. This is a tax-only designation.
Yeah, so you don't need to be showing houses. You don't need to be doing open house or anything like that. The way to qualify as real estate professionals, IRS looks at a couple of things. First, you have to spend at least 750 hours actively involved in your real estate, okay? And the second is you have to be spending more time in real estate than your other active income activities combined. So what are those activities? W-2 income, 1099 income if you're a consultant for someone else, if you're a business owner, right, that business income would be your income. So as long as you're spending more time in real estate than your other business type of income, then you potentially can qualify as real estate professional. And like Matt said earlier, the benefits could be huge, right? It's the ability to use all the real estate expenses to offset all your other income, or having to carry forward those real estate expenses into future years. And it's part of an overall planning. When we talked about income shifting, we talked about maybe buying a car and taking the deduction or accelerating depreciation. Well, all of those are great, provided that you can actually use it, right? So this is another layer of the onion to peel back and say, okay, well, now that I know I have the ability to do all these things, then what can I do to actually use that to offset maybe the W-2 income of my spouse, right? Or maybe the earned income from my medical practice, okay?
Now, again, with year end coming up, if you think you're someone or your spouse is the person involved in the real estate, if you think you're getting close to maybe being able to qualify as a real estate professional, now's the time, if you haven't done it already, to start documenting your hours. Maybe the person who's going to qualify doesn't have another job, so the only test they need to meet is the 750-hour requirement. Well, maybe they're at 650 hours, maybe they're at 700 hours. So if you know that right now, you can plan accordingly for the last 2 months of the year to figure out what else can you do to qualify. Because again, if all of a sudden we're getting to take deduct our loss this year that we generated from the home office, the accelerated depreciation, it's going to save you taxes now that, again, you can reinvest and buy more income-producing assets.
Karen Hall earlier did such a great presentation on self-directed investing, and she actually went over a lot of the points that we were going to talk about. But I think we'll just kind of add a few more. Before the end of the year, one of the key things that you want to do, if you're someone who had a lot of earned income that is from your own business, who might be eligible for a 401k that Karen was talking about earlier, one of the main deadlines you want to make sure you keep in mind is that the account itself does have to be open before the end of this year in order for you to make contributions into that particular account, okay? Now, depending on how you pay taxes, if you're a corporation or an LLC or a sole proprietor, there are different deadlines in terms of when you have to actually put money into the retirement account, but the key date not to be missed is that the self-directed 401k does have to be opened before December 31st, 2016. And what we love about the whole concept of self-directed investing, whether it's IRAs or 401ks or SEP IRAs, is that you get the ability to take a tax deduction for the money going in. That's the immediate tax savings, right? But in addition to that, that bucket of money is also able to grow for you at an accelerated manner because of two things. One, you have control over it, right? It's maybe instead of just being the stock market, you're doing real estate, you're doing note investments. So it's an accelerated growth, which is further accelerated by the fact that it has no tax drag, right? There's no tax burden. 100% of your return on investment is going to go back into more investment deals. So very, very important piece of year-end tax planning.
All right, Aaron, do we still have time for a few questions, or? Okay.
And while this is a copy of our book that it's actually sold on Amazon. So if you guys haven't had enough taxes yet, go home and pick up a copy. I think what I found out, we have a lot of clients who read this book, and after they read it, they'll come to us with pages and pages of questions, which are really good. And that's what our hope in doing the book was intended to do, is for you to read it, formulate some questions, and then talk to your advisor about how those could potentially help you.
Hi, two questions. Number one is the difference between claiming something as an expense and claiming something as a capital improvement. Which one is more beneficial? And when you read the definition of what a capital improvement is, there's a little gray area in there, and how does the IRS look at that gray area if we conclude it's the better of the two?
Right.
And then the second one is, me and my dad just bought a fourplex. We have a little bit of properties, and we're owning them as tenants in common. How do we, is it 50-50 on everything on our tax returns? And can you shift it 50-50 one year, 60-40 the next year? How does that work?
So I'll answer the second one first, just because it's quicker. The general, if you are owning it 50-50 as tenants in common, everything's got to be split 50-50. If you want to do it a different way, you could look at forming like an LLC or something as a partnership where you have some flexibility in how you allocate things. Or come talk to us at the break if you want more information about it. Expense versus improvement, generally always going to be better if you can expense something, because that means you're deducting it right now. If it's an improvement, that means you're deducting it over time. And you hit the nail on the head. The definition of improvement is very gray. It's gray for you, it's gray for us to some extent. The IRS did try to make it a little bit easier a couple years ago, but 30,000 foot level, think about it as something that's going to improve the value of a property versus restoring it or retaining its working condition. So that's very simplified explanation of it. But general rule, you know, if you can get something to qualify as a deductible repair or an expense right now, that's going to be better for you.
The kind of an example, if you have a rental property, the toilet is broken, you fix it, that's a repair. Same apartment, you decided I'm going to remodel the bathroom in its entirety, that would likely be an improvement. But do come talk to us during the break. There was a bunch of new changes that came out, like Matt said last year, about the definition of what those are and some limitations and things like that, that we can talk to you separately. Does get complex.
Hi, I have a question. I'm a business owner and I belong to a professional networking group where we trade leads and do a lot of business development. Within that group, I have colleagues and we frequently go to Disneyland. My question is my annual pass and my parking at Disneyland a possible write-off when I'm going with these people, which is typically once a month?
Who invited our client to the room?
Yeah, just so you guys know, Dana is actually our client. Good way to put us on the spot.
Yeah.
I would use a reasonableness approach, right? So I know Disneyland tickets our annual passes are very expensive. We have them as well. So I would say I wouldn't, if you're going there all the time, which I know you are, I see you on Facebook. So you probably wouldn't deduct all the, 100% of the annual pass cost, because a lot of times you're going with your son or you're going with your friends. But yes, you can take a reasonable allocation and say, okay, maybe 1/4 or 1/3 of the time it's really for business purposes. Now the tricky part is documentation. Okay, so what I would suggest is that you have some sort of documentation, email correspondences, things like that, with the people within your group and say, hey, I'm going to be at Disneyland. Let's meet at this restaurant and talk about XYZ things with respect to our networking. Okay.
Yeah, because the underlying assumption there is that when you get to Disneyland, you are talking to these people that are with you about business while you're there. Now, you don't have to talk business 100% of the time, but you at least need to talk about business a little bit. So, yeah. I think we had one in the front here. Aaron can run.
Maybe last one, and then we'll save the rest for the very end. That'd be
Sounds
helpful.
good.
Okay.
Right there.
All the way up front.
At what point should we put our real estate investments in an LLC so that the break even for the cost to have an LLC and to do the extra tax returns, outweigh the, yeah.
Right.
That's a good question. And unfortunately, the answer is it depends. It depends on every specific taxpayer, because it's not the number of rentals in an LLC. It's going to depend on the equity. So, for example, if you have one rental
100%?
property, 100% equity, then it comes down to risk tolerance level. Okay, so my question would be then, if you have 100% equity on a $500,000 property, is it worth it for you to pay the state $800 knowing that your net worth is more secure if someone were to sue on this particular property? Okay, I mean, another example would be if you had 3 rental properties with 0 equity at all. Does it make sense for you to put that into an LLC? Well, potentially, even if you have no equity in the properties, by putting those properties into an LLC, you are potentially protecting the equity in your primary home, in your stock investments, and all of your other net worth that's outside of the real estate. But your key question, though, is not really a tax question. It's actually a better question for an asset protection attorney, because based on my understanding, there are other things that could be done to protect your assets, and not just strictly looking at an LLC and the fee for California.